commentary for the last week of January 2026. And the main event of the week for market watchers was the precipitous fall of gold, which was down by about 10% and silver by about 30%. Now, although that's a big fall and a big market move, it actually only takes it back to where it was about 2 weeks ago, because it was up by 25% until that point. So still up by more than 10% for the year. Now, the proximate cause for that was Trump putting forward Kevin Walsh as his nominee for the next chairman of the Federal Reserve. Now, there had been some speculation that he wanted someone there who was notably dovish and who would pull interest rates down. And there was this sort of idea of the so-called debasement trade, where you've seen a weaker US dollar associated with, but also there's got to be some probably speculative pressures within the precious metal complex, as you didn't really see, as you can see there on the bottom panel, you didn't see bond yields move around quite so much. And the dollar, although it was down 4% last week and it bounced back a couple of percent on this news, that doesn't seem to be the main game. So probably some speculation as well in gold and precious metals. Now, the rest of the market's kind of dwarfed by that scale of sort of up 10%, down 15%. But you can see within that, US markets, again, a little bit volatile around that time, down about 2%, and most other markets are pretty steady. When you look at January as a whole, you can see emerging markets actually up by 10%. Now, we'll get onto that because there's been some polarization there as well, which we'll talk about a little bit later. The Australian market up by 1% or so, Japan up by a few percent, and global small caps and US small caps up by about 5%. When you put that all together, but also taking into account the weakness of the US dollar, it means that diversified portfolios, say a 70-30 portfolio in Australia, with 30 or 40% in Australian equities, similar amount in international equities, and the rest in bonds and cash, for instance, that was up about sort of 1%, and a more defensive portfolio, maybe a balanced or conservative portfolio, up by 0.5% or a little bit more. So overall, a reasonable January. And one of the things that's really sort of held markets together has probably been the US reporting season, which, with a third of companies having reported now, is actually looking pretty solid, getting up into high single digits year-on-year growth. It looks like it's going to be, and about 80% of companies have beat their estimates. But a couple of anecdotes that were quite telling last week. You had two big reports from Meta and Microsoft. Now, Microsoft actually came in with whopping numbers, beat expectations, but their guidance on spending and the profitability around their AI spend was a little bit underwhelming. And that was enough for markets to mark down the stock by about 10%. Meta, on the other hand, beat and also guided quite positively and got rewarded for that. Now, probably what's on investors' minds is that valuations are already quite full, and there's an expectation that there's going to be some return on investment on AI spend. And with, nervousness around valuations, that's where you can see these divergence. So no clear trends outside of that in the tech sector, but signs of worries and markets looking for some reassurance. Elsewhere, stocks like Boeing and General Motors coming in quite strong, and generally other data pointing to quite a resilient and strong US economy. Now, in this week's What We're Working On video, we talked to Tassos Totopoulos of Trenetra, who we tend to check in every few months with. We wanted to check in this week in particular because of some of the polarization that we're seeing in emerging markets. And nearer term, we saw a few ructions in the Indonesian stock market as MSCI called out the lack of liquidity and threatened if they didn't improve some of the governance, then improve some of the liquidity in the local market, they might consider demoting it to a frontier stock. Now, Indonesia is actually quite a large and growing economy, a very large economy. And the stock market is, somewhat nascent in some respects, but Trenetra see that as a happy hunting ground of very good value stocks that are growing very strongly with a strong Indonesian consumer. So we were interested to talk to him about that and whether that was going to have long-lasting effects. And he thinks that actually this will be a force for good for that market, and is staying with some of the stocks, about 2 or 3 of them that they have in that universe, about 10% of the portfolio or something. But the bigger issue for this manager, and this is kind of a more of a theme that we're looking at, is the polarization within emerging markets has meant, and if you look at this chart here, you can see over the last year or so, the Kospi index in Korea up by 120%. Now, that index, a little bit like Australia, highly concentrated, but the two biggest stocks there, Samsung and SK Hynix, now count for 45% of the index. Now, they're being driven by not just the semiconductor boom for AI, but also memory chips as well. Now, it's somewhat difficult to parse because these stocks are not very, they've always been very, very cheap. They don't grow very much. The memory chip industry is famously cyclical. So investors tend not to assign a huge multiple to it. But it's been on a bit of a tear because there's great demand for these things. There's lots of cash coming in. They don't actually look expensive. Now, the quandary for someone like Trinetta Investment Management is that they focus on emerging market consumers, whereas this sector is very much not that. It's very much related to Western markets. It's arguable whether these really are emerging markets. So it's kind of uninvestable for them. But what do you do when a large part of your index, so including Taiwan, which is mostly Taiwan Semiconductor, is Korea and Taiwan? That's about now 25% of the index, 10% in TSMC alone. When it's such a big portion of your index, what do you do? Now, we would probably be asking more questions if they did start investing in those stocks, but by the same token, it creates a big headwind for them, especially when you're focusing on benchmarks. And we've seen the same thing in Australia. Things like CBA, which sort of looks like a little bit of a sitter, very overvalued. Should investment managers just invest in those stocks because they're a large part of the index, or should they stick to their knitting? Completely open story, and something that we've been talking about with many managers, especially ones that operate in these quite concentrated indices. And so this week we talked to Tassos Tostopoulos of Trinetta Investment Management about the benefits of diversification, which, to be honest, we're quite happy with, because from a portfolio context, it's very clear that he's bringing something different to the portfolio, to the overall portfolio. But closer to home, next week, we'll also be talking to Tim Binstead, our head of Australian equities, about investing in the Australian equity landscape, where we've got similar issues. But this is the nature of polarized markets, and it's up to investors to decide what they want their managers to be doing. Is it tracking a benchmark, or is it helping portfolios in other ways and providing diversification? Open question, no right answers, but makes for interesting times. Anyway, an interesting conversation about emerging markets in this week's video. If you want to tune into that, and next week we'll be turning our attention to issues of concentration within the Australian market. Look forward to talking then. Thank you.